Ever thought there was a simple way to get rich that everyone could accomplish without any prior experience? Well, newsflash, there is. And I'm talking about index funds. Investing in index funds is extraordinarily simple, highly lucrative, and in most circumstances, actually outperforms the returns of professional investors. Almost 90% of actively managed investment funds fell short of outperforming the market over a 15-year period, according to a 2020 study. In other words, even professionals who dedicate their entire careers to outperforming the market are unable to outperform the majority of investors who employ the index funds approach. That is why in this video, we will be sharing with you these top index funds that will make you rich. And if you haven't already, it would mean so much to us if you subscribe and hit the notification bell. It's totally free, and that way you will surely be updated whenever we upload new videos. And with that said, let's get back to the content, shall we? Since the previous couple of years, the world has changed, and most people today seem to be just interested in stocks and cryptocurrencies rising up in the sky. You understand that it's exciting to watch your money grow quickly, but the sad reality is that many people make dangerous investments in amounts greater than they can bear to lose. This implies that many people will be left without anything if and when a crash occurs, which it always does. And those that are able to weather the storm are typically those who also make long-term investments. Consider index funds your hidden weapon because they were designed for it. Always prepare a backup in case the worst strikes. Let's explore what they are in detail. As an investor, you may now single out the ones you like the most. Individual stock investing is what this is. The beautiful thing about index funds is that you can own all the companies in the basket with just one easy purchase. But if these companies fail or have a value drop, you're in danger. Without having to go through the effort of making your own manually chosen portfolios or hiring pricey managers to do it for you. This is due to the fact that they are passively managed, which greatly increases their cost effectiveness. It's all about creating long-term income streams rather than focusing on quick gains. The truth is that if a stock or cryptocurrency can offer you these kinds of gains, it may also move in the opposite direction. The brilliant thing about index funds is that even if one company inside the basket was performing poorly, the other companies would still be there to support it. An index fund seeks to follow an index, which is comparable to a leaderboard in sports. They can rank things like currency, location, business type, and firm size. Nevertheless, because of the wide range of options, let's pretend we're in a grocery store and go through the 3 best stock baskets to invest in. Always keep in mind that none of this should be interpreted as financial advice. These are simply the investments we recommend. We merely want you to be conscious of these investments. So before investing, please conduct your own research. Basket number 1, the S&P 500 Index. Among index funds, this is the big daddy. Such an excellent financial decision. In comparison to the newest mania like Shiba Inu, the S&P 500 has returned investors an average of 8 to 10% per year. Nevertheless, it is considerably less volatile and consistent than that. What's in the basket though? That sounds brilliant. The S&P 500, however, represents the top 500 American corporations. To be precise, there are 505 stocks. A company must fulfill certain criteria in order to be listed in the S&P 500, such as reaching a certain market cap, having the majority of its shares held by the public, and being a publicly traded company for at least a year. As a result, if you purchase one share of the S&P 500, you will also own a small portion of companies like Amazon, Tesla, Apple, PayPal, and a host of others. The fact that the S&P 500 is evenly distributed across so many outstanding American businesses is one of its advantages. They are more like global corporations now. To be honest, as the development of the internet has muddled international boundaries and increased global interconnectedness. Due to the power of compound interest, their historical return of 8 detention facilities allowed their investors to make a fortune over time. However, it's important to note that 5 large technology stocks make up 23% of the S&P 500, which is currently a bit tech-heavy. You decide whether to view this as good or bad. Which one do you choose out of the numerous index funds that follow the S&P 500? That depends on where in the world you live, as well as the investing platform you're utilizing. The VFIAX Index Fund, or the VOO ETF, is considered to be the finest in the USA. The VUAG is likely to be the best in the UK. Nevertheless, there are a ton of alternative ETFs that follow the S&P 500. The dividends being reinvested into the fund are another thing to watch out for. The only true distinction between an index fund and an exchange-traded fund, commonly known as an ETF, is that the latter can be bought or sold at any moment during the day, exactly like a stock, as long as the market is open. Only one full purchase of an index fund may be made each day. Since an ETF can be purchased in fractional shares, you are not required to purchase a whole share and are free to invest any amount you choose. For instance, if a fund's price is $500, you must pay $500. This is excellent if you want to dollar cost average or if you're just getting started. You can accomplish this by taking a weekly stand in order, and you won't even be aware that the money came from your bank account. Since there isn't much of a difference between an index fund and an ETF, choose the one that's right for you and invest in it. Before we continue, we would love to know which among these stocks piqued your interest the most. Please feel free to share your thoughts in the comments section. Once you're done, let's get going. The Total Stock Market Index makes up basket number 2. The definition of diversification is best summed up by the Total Stock Market Index. You really can't get more involved in the game for less money than this. Nevertheless, if you want to put money into an investment for a long time without having to check or even think about it, this is probably the right fund for you. When you invest in everything, the market as a whole will benefit, and you ought to be okay unless a terrible crash takes place. However, even if it does crash, things usually recover over time. The drawback of this index is that it is reliant on the market as a whole going upwards. This implies that a specific stock in which you have a significant amount of confidence could soar all the way to the moon. But because that one stop doesn't contribute much to the index fund, you might not realize those gains. Emerging Markets Index comprises the third basket. Whether you agree with this or not, it's crucial to have at least a little bit of exposure to emerging economies, as some analysts believe that they will continue to grow. Investing in the S&P 500 is okay, but you'll miss out on significant gains made by China or another emerging market if you do so. Undoubtedly, the riskiest index fund category we've covered thus far is emerging market funds. These funds can include a significant concentration of Chinese companies and stocks from many other developing markets. Many of the top economies in the world are emerging markets, according to a list of the biggest economies in the world. So investing a small sum of money for diversification just makes sense. Additionally, these developing markets have an enormous population. Therefore, there is undoubtedly room for expansion, both within their own nations and in exports. The Metaverse Index is in basket number 3.5. This is somewhat of a bonus, with just one transaction. The Meta ETF simplifies things by providing exposure to a wide range of businesses that are expected to profit from and participate in the metaverse. However, as the metaverse hasn't yet existed, all of this is currently simply theory. The top 10 firms in this ETF are not all ones I would suggest either. Therefore, that's undoubtedly something to watch for and take into account. This ETF also has a quite high expense ratio of 0.75%. While this might not seem like much, it's far higher than many of the products we've already discussed. Looking at the stocks the Meta ETF holds and then purchasing the ones you want separately is, in my opinion, the best course of action. However, if this sounds like too much work, ETF is unquestionably something worth considering. The most crucial part is starting, even though when you first hear about index funds, you might assume that investing is just for the rich. You can start investing with index funds even if you have little knowledge, which allows you to start the snowball effect. Therefore, if you've been contemplating whether to begin your long-term investment quest, the time is now. Thanks for watching. I hope you learned something useful today. And if you haven't already, make sure to subscribe and hit the notification bell so you'll be updated whenever we upload new videos. Till the next one, goodbye!